Could your business grow exponentially without giving up a single percentage of ownership? Imagine a world where rapid expansion doesn't come at the cost of dilution, where you retain complete control of your vision, your company, and your destiny. For decades, venture capital has been the go-to fuel for high-growth startups, the golden ticket to scale. But what if there's a new player in town, one that promises significant capital without demanding a slice of your pie? Today, we're diving deep into Uncapped, a rapidly emerging alternative funding model, and asking the crucial question, is Uncapped a substitute for venture capital? To truly understand if Uncapped can step into the shoes of traditional VC, we first need to dissect what each of these funding avenues brings to the table. Let's start with the titan of startup financing, venture capital. Venture capital, or VC, is essentially private equity capital provided by venture capital firms or funds to startups, early stage, and emerging companies that have been deemed to have high growth potential or which have demonstrated high growth. These firms or funds invest in exchange for an equity stake in the company. The benefits of venture capital are compelling, especially for companies aiming for a meteoric rise. Firstly, there's a sheer volume of capital. VC firms can inject millions, sometimes hundreds of millions, into a startup, fueling aggressive expansion, product development, and market penetration that will be impossible through bootstrapping or traditional debt. This substantial funding allows companies to take big risks and aim for disruptive innovation. Secondly, VCs offer invaluable expertise and mentorship. These aren't just passive investors. They often comprise seasoned entrepreneurs, industry veterans, and strategic thinkers who have navigated the startup landscape countless times. They provide guidance on everything from business strategy and product market fit to talent acquisition and scaling operations. Their experience can be a critical compass in the often turbulent waters of startup growth. Thirdly, VCs open doors. They have extensive networks of contacts, potential customers, strategic partners, follow-on investors, and even future acquirers. Tapping into these networks can accelerate a company's growth, facilitate crucial introductions, and even pave the way for a lucrative exit. Their endorsement also lends significant credibility to a startup, making it easier to attract top talent and further investment. Finally, there's the shared risk. Unlike a loan that needs to be repaid regardless of success, VC funding is equity-based. If the company falters, the VC firm loses its investment, not the entrepreneur. This alignment risk can free founders to pursue ambitious, high-risk, high-reward ventures without the crushing burden of debt repayment hanging over their heads. However, the allure of venture capital comes with significant trade-offs, and these trade-offs are precisely why alternatives like Uncapped are gaining traction. The most prominent downside is, of course, dilution of ownership. With each funding round, founders give up a percentage of their company. Over multiple rounds, this can mean relinquishing substantial control, sometimes even becoming a minority shareholder in their own creation. This loss of equity directly impacts future financial upside for founders and early employees. Now, let's turn our attention to Uncapped. Uncapped is a prime example of revenue-based financing, or RBF. In simple terms, Uncapped provides capital to businesses in exchange for a fixed percentage of their future revenue until a predetermined amount, the original capital plus a fee, is repaid. It's not a loan in the traditional sense, and crucially, it's not equity. Uncapped focuses on businesses with consistent, predictable revenue streams, primarily in the e-commerce, SaaS, and subscription-based sectors. The core promise of Uncapped and RBF in general is non-dilutive funding. This means founders retain 100% of their equity and, consequently, full control over their company. For entrepreneurs who are deeply committed to their vision and want to avoid giving up ownership, this is an incredibly attractive proposition. You get the capital you need to grow without sacrificing a piece of your pie. Another significant advantage is the flexibility of repayment. Unlike traditional loans with fixed monthly payments, Uncapped's repayment model is directly tied to your revenue. In months where your sales are high, you repay more. In slower months, your payments adjust downwards. This aligns perfectly with the fluctuating cash flow of many growing businesses, reducing financial pressure during lean periods and preventing the kind of crippling debt that can derail a promising startup. Speed of funding is another major differentiator. While VC rounds can take months, Uncapped typically offers much faster access to capital, sometimes within a matter of days or weeks. This agility allows businesses to seize market opportunities quickly, whether it's scaling marketing campaigns, investing in inventory, or launching new product lines. The application process is often streamlined, relying on data integration with your existing sales and accounting platforms rather than extensive pitch decks and complex financial models. Furthermore, Uncapped typically doesn't require personal guarantees, unlike many traditional bank loans. This reduces the personal financial risk for founders, allowing them to focus on the business without jeopardizing their personal assets. The costs are transparent, usually a flat fee on the capital advanced. So you know exactly what you'll owe from the outset, without the complexities of interest rates or hidden charges. It's also important to consider that uncapped and venture capital are not necessarily mutually exclusive. Some businesses might leverage uncapped for their initial growth phases, proving their revenue model and market traction, before seeking VC funding for a larger, more aggressive scale-up. This VC-light approach allows founders to preserve more equity in the earlier stages, increasing their leverage and valuation for future equity rounds. Conversely, a VC-backed company might use uncapped for specific, short-term working capital needs to optimize cash flow without drawing down more equity from their investors. In essence, uncapped is a powerful and increasingly popular alternative to traditional debt financing, offering a founder-friendly approach to growth capital. It addresses a significant gap in the market for established businesses seeking non-dilutive funds and greater control. It empowers entrepreneurs to grow on their own terms, free from the often demanding oversight and aggressive timelines associated with venture capital. However, uncapped is not a universal replacement for venture capital. VC still holds its reign for early-stage, high-risk, high-reward ventures that require substantial capital, deep strategic partnership, and extensive networks to achieve their audacious goals. The choice between uncapped and venture capital isn't about which is better, but rather which is the right fit for your specific business, its stage of development, its revenue model, and the founder's long-term vision. Understanding the distinct benefits and limitations of each is key to making the most informed decision for your entrepreneurial journey. With that said, thanks for watching, and until next time.